Picture this. You're staring at your trading account and the balance is embarrassingly small. Maybe it's $500, maybe it's $2,000, but whatever it is, it's nowhere near enough to generate the kind of income you're dreaming about. You know you have the skills. You can read charts, you understand market structure, you've been profitable on your demo account, but here's the brutal reality. Even if you're making 10% returns consistently, 10% of $2,000 is only 200 bucks. That's not changing your life anytime soon. But what if I told you there's a way to multiply your trading power by 50 times or even 100 times without risking your own capital? What if you could go from trading a tiny account to controlling $150,000 in buying power? This isn't some get-rich-quick scheme or fantasy. This is the world of funded trading accounts, and it's completely real. Today, I'm going to walk you through exactly how to pass a funded account evaluation. Not just the theory, but the actual step-by-step process that separates the traders who get funded from the ones who keep failing these challenges over and over again. By the end of this video, you'll understand the psychology behind these evaluations, the specific strategies that work, and the critical mistakes that destroy most traders before they even get started. Here's what most people don't understand about funded accounts. These aren't charity programs. These companies aren't just handing out free money to random people who think they can trade. They're businesses with sophisticated risk management systems designed to identify genuinely profitable traders while weeding out the gamblers and the delusional. The statistics are sobering. Most traders fail these evaluations multiple times before succeeding, and many never pass at all. But here's the thing that changes everything. The traders who consistently pass these challenges aren't necessarily the smartest or the most experienced. They're the ones who understand that passing a funded account evaluation is fundamentally different from regular trading. It requires a specific mindset, a particular approach, and most importantly, the discipline to execute a plan even when emotions are running high. Let me break down what's really happening when you take one of these evaluations. You're essentially auditioning for a job. The prop firm is asking one simple question. Can this person generate consistent profits while managing risk appropriately? They don't care if you can predict market direction perfectly. They don't care if you understand every technical indicator ever invented. They care about one thing. Can you make money without blowing up the account? This is where most traders get it completely wrong. They approach these evaluations like they're trying to prove how smart they are. They overtrade, they chase huge winners, they ignore risk management rules, and they treat the evaluation like a lottery ticket instead of a job interview. Then they wonder why they keep failing. The successful approach is completely different. It's methodical, it's boring, and it's incredibly effective. Instead of swinging for the fences, you're playing small ball. Instead of trying to pass in 2 days, you're planning for a steady progression that demonstrates consistency over time. Instead of focusing on the profit target, you're obsessing over the drawdown limits. Think about it this way. If you were hiring someone to manage your money, would you choose the person who doubled the account in 3 days with wild, unpredictable trades? Or would you choose the person who steadily grew it over weeks while never risking more than they should? The answer is obvious, but when money is on the line and emotions take over, most traders choose the first approach. Here's something that might surprise you. The most successful funded traders often take longer to pass their evaluations than the unsuccessful ones. Why? Because they're not rushing. They're treating each trade like it matters, which it does. They're building habits that will serve them not just during the evaluation, but throughout their entire funded trading career. Let's talk about the psychology for a moment. When you put your own money down for an evaluation, something changes in your brain. Suddenly, there's pressure, there's fear, there's this voice in your head saying you need to pass quickly to justify the cost. This psychological pressure is the silent killer of trading performance. It makes you impatient, it makes you take trades you shouldn't take, and it makes you abandon your strategy right when you need it most. The traders who pass these evaluations consistently have learned to manage this psychology. They've developed systems that remove emotion from the equation. They've practiced the specific skills needed for evaluation trading, which are different from the skills needed for regular trading. And most importantly, they've accepted that passing an evaluation is just the beginning, not the end goal. Every funded account company has slightly different rules, different profit targets, and different risk parameters. But the underlying principles remain the same. They want to see consistent profitability, proper risk management, and emotional stability under pressure. They want to know that when they give you a larger account, you won't immediately blow it up because you can't handle the psychological pressure of trading with house money. The strategy I'm about to share with you addresses all of these concerns. It's designed specifically for the evaluation environment, taking into account the unique psychological pressures and rule structures that make funded account trading different from everything else. The first thing you need to understand is that your trading strategy for evaluations must be laser-focused on one objective: profit consistency while staying far away from maximum drawdown limits. This isn't about showing off your market prediction skills or proving you can catch the perfect reversal. This is about demonstrating that you can follow a systematic approach that generates steady returns without catastrophic losses. Here's the framework that actually works. You need 3 core elements working together like a machine: risk management that's so tight it feels uncomfortable, entry criteria that are crystal clear with zero room for interpretation, and position sizing that makes large losses mathematically impossible. Most traders get 1 or maybe 2 of these right. The ones who pass get all 3 locked down perfectly. Let's start with risk management because this is where 90% of evaluation failures happen. You cannot, under any circumstances, risk more than 1% of your account balance on any single trade. I don't care if you see the most obvious setup of your entire trading career. I don't care if you're absolutely certain the market is about to move in your direction. 1% maximum, no exceptions, no negotiations. But here's where it gets tricky. That 1% isn't calculated from your starting balance. It's calculated from your current balance, including any open positions. So if you're up $2,000 and you have an open trade that's currently profitable, your risk calculation changes. This dynamic risk management is what separates professionals from amateurs, and it's exactly what evaluation companies are looking for. Your entry strategy needs to be mechanical. No gut feelings, no trading the news, no jumping on momentum, plays that look too good to be true. You need a system that gives you clear buy and sell signals with specific price levels for entry, stop loss, and take profit. The strategy itself matters less than your ability to execute it consistently without deviation. Here's a simple but effective approach that works across multiple market conditions. You're looking for market structure breaks on higher time frames combined with precise entries on lower time frames. Wait for a liquidity sweep of significant highs or lows, then look for confirmation through break of structure, inverse fair value gaps, or Fibonacci extensions. This gives you high probability setups with clear risk parameters. The key is patience. You're not trying to trade every day or catch every move. You're waiting for your specific setup to appear, then executing it exactly according to your rules. Some days you won't trade at all. That's not just okay, it's preferred. Evaluation companies love traders who can sit on their hands when conditions aren't right. Position sizing is where most traders sabotage themselves without realizing it. They calculate their risk correctly, but then use position sizes that are way too large for the evaluation environment. Remember, you're not trying to get rich during the evaluation. You're trying to prove you won't lose money. There's a massive difference between these two objectives. For most evaluations, you should be using micro lots or small position sizes that allow you to survive dozens of losing trades in a row. Yes, this means your profits will be smaller and it might take longer to reach the profit target. But it also means you're virtually guaranteed not to hit the maximum drawdown, which is infinitely more important than reaching the target quickly. Here's something most traders never consider. The evaluation period is actually your friend, not your enemy. You have weeks or even months to reach your profit target. There's no rush, no pressure to perform immediately. The traders who fail are the ones who try to pass in the first week. The traders who succeed understand that consistency over time is what matters. Your daily routine during an evaluation should be completely different from normal trading. Start each day by reviewing your rules, your risk parameters, and your current account status. Check the economic calendar for any high-impact news that might affect your markets. Identify your potential setups for the day, but don't force trades if your criteria aren't met. When you do take a trade, document everything: your reasoning for entering, the specific signals you saw, your emotions at the time, and how the trade developed. This documentation serves two purposes. It keeps you accountable to your system, and it provides valuable feedback for improving your approach. The psychological aspect cannot be overstated. You're going to have losing streaks during your evaluation. You're going to watch perfect setups develop right after you've hit your daily loss limit. You're going to second guess your strategy when it's not working. These moments separate successful candidates from failures. When losses start mounting, most traders panic and abandon their system. They start taking bigger risks to make back their losses quickly. They ignore their rules because they feel desperate to pass before they lose more money on evaluation fees. This is exactly when you need to stick to your plan most rigidly. The mathematics are on your side if you follow the system. Even with a modest win rate and small position sizes, consistent execution over time will get you to the profit target while keeping you far from the maximum drawdown. But only if you have the discipline to execute the same way on day 30 as you did on day 1. This approach isn't glamorous. It's not going to generate exciting stories or massive daily gains, but it works. And in the world of funded account evaluations, working is all that matters. Look, passing a funded account evaluation isn't about being the smartest trader in the room or having some secret strategy that nobody else knows. It's about understanding that this is a completely different game with completely different rules. It's about having the discipline to execute a boring, methodical approach when every instinct is telling you to take bigger risks and chase faster profits. The traders who succeed treat these evaluations exactly like what they are: a job interview where consistency matters more than brilliance, where risk management trumps profit maximization, and where patience beats speed every single time. They understand that the real challenge isn't hitting a profit target, it's proving they can follow rules under pressure. If you take nothing else from this video, remember this: the prop firms aren't looking for traders who can get lucky once. They're looking for traders who can avoid getting unlucky consistently. Focus on not losing money, and the profits will take care of themselves. Your funded trading career starts with that first successful evaluation. But it's built on the habits you develop during that process. Treat every trade like it matters, respect every rule like your career depends on it, and never forget that in this business, the tortoise doesn't just beat the hare. The tortoise gets funded while the hare keeps paying evaluation fees. The opportunity is real. The money is real. Now it's time to prove you're the kind of trader they're looking for.